How do you avoid the constant grind of small losses? Identify markets when the market conditions are not in favor of your setup. Unfortunately, the only way to do that is go through these cycles and learn from that. That's not something you can learn from a book. You can learn a setup from a book or from a YouTube video or from a blog post, but you cannot learn identifying, the favorable and unfavorable conditions from a book, or it's something you have to go through. Obviously, you can learn about the warning signs, and but the rest you kind of have to experience it and learn from the pain of losing. That's really and also it's very important you learn the right lessons. Unfortunately, what a lot of people do, they blame their losses on other factors, and obviously those people will never learn anything in life. You also have to learn the right lessons that the market is teaching you. I think that's a very important thing. From who did I learn? First, it was Tim Sykes. That's the first trader I found back in 2011. Initially, it was Tim Sykes, but I didn't start trading that setup until like a few years later when I got the US trading broker accounts. But I learned from several people the same setup. Obviously, a lot of people have figured the setup out because it works. Anytime you have something that works, people will figure it out. Multiple people. Isn't Tim Sykes a scam? Well, his trading method is not a scam. It works really well. He calls it supernova. Tim Sykes is definitely not even in my top 50 of top traders. He's a mediocre trader. He has a good setup, but he hasn't really figured out. He makes money selling subscriptions. That's what he does. Like a lot of traders. He could probably make more money if he was able to scale his setup up than selling all of these subscriptions. But again, a bunch of profitable traders starting a subscription service. I don't know. I'm a little bit skeptical. Well, it's not really passive income. It's very active income. They have to come up with content all the time. It's definitely not passive income. But yeah, it's an extra cash flow. But if you're that profitable, you don't need any extra cash flows. If you've been trading for a decade plus, you should be making 10 million plus per year. You don't need a few 100,000 more per year from a chat room. So I don't know, it's just a bit sketchy. Yeah, Nathan Michaud, he's a very good trader. But he would also make more money if he just increased his time frames a little bit. I'm pretty sure about that. I know he has started swing trading more. But he's had his service for like 10 years. I think he had like a blog in the beginning, I think, Investors Live. Like his community is really old. He had his community for 10 plus years. I don't think even he was a profitable trader when he started blogging about stocks. But there's a difference, being a successful trader for many years and then suddenly starting a subscription service. I just find that a little bit sketchy personally. Now obviously there could be many different motivations about it, but what you can do, you can trade the same setups but sell them more aggressively. That's one way to adapt to harder markets. You're going to decrease your size, trade less, sell more aggressively. There's many ways of doing things. I personally just prefer to sit back and chill, wait for the easy money. I've traded hard penny markets so many times, it just ends up in frustration. Like a good market, like you're not supposed to work hard. Like trading shouldn't be hard. You shouldn't be sitting there and working your ass off, making trades all the time, and the trading should be like you should only trade a certain setup when the conditions are good for that setup. That's something I realized over the years. I've traded so many of these choppy, difficult markets, and even if you make some money, it's like it was barely worth it, because in a good market you will make more money in a few days than you would make in a few months in a hard penny market. So you may as well take a step back, chill, relax. You can do some trades here and there, but don't just constantly look for trades. A good setup, a good trade should be obvious. You're looking at it, you're like, wow, that's an insane setup. That's how it's supposed to be. You shouldn't be looking with a microscope or a telescope or whatever for trades. They should be kind of obvious. They should be screaming in your face. Now, obviously, it takes a lot of experience to get to that point, to know which is which. My $1 million loss on TVIX. I was a little bit too early on TVIX. If you're too early when shorting, you're dead. Let's see, I'm gonna show you. Yeah, so this happened, okay? So I went short on this day here. It looked overextended and all, right? I went short over the weekend. I had good entry, like opening range lows. I locked in some profits. It closed weak, so I'm like, oh yeah, this thing is gonna go back to 140s. And then on Monday, this thing gaps up. It gaps up 50%, and I take a $1 million loss on it. I covered it pre-market. That was my $1 million loss on TVIX. Shorting is hard. You're gonna get run over a lot of times. That's what position sizing is so important. And you can't be too early. You need to wait for the overextension. And even even when you get the overextension, sometimes you will still get run over. Most of you will just get, you're just gonna blow up trying to short this kind of a method. Poker face, I do a quick calculation in my head, because I rarely want to be overnight long any stock more than 20-25% of my count. And also those are only like if they are all like large caps. Like if it's a mid cap, I think Livongo is a mid cap. Yeah, it's a mid cap. On something like Livongo, I would never have more than 20% of my account in it overnight. How do you adjust your trading during times of underperformance where you feel you're not in the best stocks that are moving? That's a very good question. I'm not sure I have a good answer to that. I feel that feeling is something I feel too. Like I was very frustrated, when the market initially bounced and I was shorting it. Or not shorting, I was going long too, but I was so super cautious and I missed out on the first big bounce in the markets. And I'm like, wow, the markets are up, there's a lot of stocks that are up, and my accounts are pretty much sideways to a little bit down. And the best thing to do is take a step back and I guess do more of what works and do less of what doesn't work. It's hard to kind of give a good answer to that, because I'm not sure myself what the best thing to do is. It's easy to start doing dumb things when you have the FOMO kind of a feeling, where you feel like you are underperforming and then you start chasing things and pushing size on wrong stuff, etc. If I was able to use only daily and 1 hour charts, that would be fine. You know what? I think I would be as profitable as I'm now, pretty much. I think so. I guess I would miss out on some of the plays, like the airlines on the opening range lows yesterday. Those kinds of trades would be very difficult. Like some of my short plays. But overall, I don't think I would be much less profitable. Hard to say. I would definitely be more focused, I guess. If you're a swing position trader, the intraday chart doesn't give you a lot of value. Only again on the if you know, on the faster moving stocks. I would probably miss some trades, but I would also miss a lot of losing trades. You should risk more on higher conviction trades. I don't think you should risk the same dollar amount on every trade. Absolutely not, no. Because not every trade is created equal. There are once a week opportunities, there are once a month opportunities, and then there are once a year opportunities, and you gotta size accordingly. Now, obviously, to know which opportunities are worth it to size more on, it takes years of experience. So I guess, you know what, it depends. Like if you're a new trader, you should probably risk the same dollar amount on, or the same percentage of your account on every trade. But once you get more experienced, that's when you should start, you know, betting more on trades that you have higher conviction in. But if you're new, yeah, I guess, yeah. I mean, since you're asking the question, I would say yes, you should be risking the same dollar amount. Yeah, exactly. Takes experience. You gotta know which setups and which market conditions allow for bigger size. Yeah. Like trading is very dynamic. It's kind of hard to give a blanket approach because, you know, it depends on so many things, you know, who you are, where you're coming from, you know, what the market conditions are. It's just super hard to answer some questions. But you shouldn't suffer in a bear market. There is no difference. Like for you as a trader, there should be no difference between something that happened, I don't know if you what you want to call it, bear market, crash, mild pullback. What happened February, March last year when the Nasdaq pulled back 32% in a month? Like there should be no difference between this and what happened in say 2007, 2008, where we actually had a multi-year bear market or 2-year bear market, and the Nasdaq went down 55%. As for us as a trade, it shouldn't matter. You should be suffering. If you're suffering, you're doing something wrong. Struggle shouldn't be an aim, but you will obviously struggle. And the faster you learn how to listen to the markets, the faster your suffering will end. Unfortunately, I wasn't too fast. So I had a lot of periods where I struggled too much, unnecessarily, because I didn't listen to the market. I kept doing the same thing, even though it was obviously not working. And I was slow to adapt. Now I'm a little bit smarter, because I've suffered too much, and I just don't want to suffer again. I refuse. I'd rather play Hearts of Iron 4. But my point is, there should be no difference between this, a multi-year 55% drawdown, and something like happened, last February, March, because there are very few setups. And when the market is going straight down, there are no setups. Now I'm talking strictly on the long side. I'm talking strictly about breakout setups. Obviously, there are other types of setups you can trade. My point is there should be no difference. You shouldn't do anything differently. You should do the same thing. Take it chill. Realize there are easy markets to make money. There are hard markets to make money, and there are markets you're gonna lose money faster than you made it. Right now, it's just I still see a lot of things that may be that are looking good. That could be potential 4 or 5-star setups in a couple of days. But there's also a lot of bear flags in many of the leading stocks, and many are breaking down. So, it's a mixed picture. It's a mixed picture. Gotta be careful. Definitely not the same market we had between, say, November and February, with the relentless buying. Now, obviously, if you're a day trader, there's always something to do. But I'm not a day trader. I'm talking strictly swing trading. But I also, as a day trader, you always obviously have to adapt. If you are, like, let's say, a long only day trader, obviously there's not going to be as much opportunity in a falling market than there is in a rising market. But if you're a long short, obviously you're going to short more in a falling market than in a rising market. That's just how it is.